Hi, I'm Tim Phillips at Phillips and Company Advisors. Everything we do is built around one idea, helping you build not just wealth, but confidence, clarity, and long-term financial strength. Because the truth is, success with money isn't about spreadsheets alone. It's about behavior, patience, and perspective. That's why I'm excited to introduce our friend Morgan Housel, best-selling author of Psychology of Money. Morgan is one of the most thoughtful voices in finance. He brings stories, history, and human behavior together in a way that makes complicated ideas simple and powerful. Morgan, thanks for being here and take it away.
Hey everyone, Morgan Housel back here again. Most of what is important in investing is not intuitive. Not complicated, but not intuitive. Think about this. Imagine you meet a genie who can grant you one of two wishes. He can either give you a trading strategy where you're buying and selling stocks all the time that generates a guaranteed 20% annual return for the next 20 years. Sounds pretty good. Or he can grant you a buy and hold strategy where you're just buying stocks and leaving them alone that will generate a guaranteed 14% annual return for the next 20 years. Trading strategy at 20% per year or buy and hold at 14% per year. Which of those would you pick? Now, if you're like 99% of investors, the obvious answer is the trading strategy. But it's the wrong answer. For almost all investors, that's not what you want. The buy and hold strategy that earns 14% per year will outperform the trading strategy that earns 20% per year. This is not a trick question. And the explanation for why this is the case is shockingly obvious, but so many investors, professional and amateur, overlook it. And the answer is taxes. Capital gains taxes earned in stocks held for less than 1 year are taxed as ordinary income, which is as high as 37% per year just for your federal taxes, not even including state taxes. But profits on a stock held for more than 1 year are generally taxed at a much lower rate. It's usually no higher than 23.8%, depending on your income. Not only are long-term returns taxed at a lower rate, but because gains are only taxed after you sell the asset, maybe way down in the future, your rising account balance benefits from the full power of compounding returns over time. And that effect is so powerful that a 14% annual buy and hold strategy easily outperforms a trading strategy that earns 20% per year, but realizes taxable gains every year. Now, if you are in the 33% federal tax bracket, and you live in a state with a 7% income tax, let me show you how a 20% per year trading strategy, where the gains are taxed annually, compares to a buy and hold strategy where you are only taxed at the end of 20 years. It's pretty astounding. You've probably heard about the percentage of mutual funds that don't beat an index fund, that underperform their benchmark, and it is astounding. It's about 88% of actively managed stock funds have trailed an index fund over the last decade, according to Vanguard. As lousy as those numbers are, it's actually much worse when you factor in taxes. Since most of those funds are active funds that are constantly turning over their portfolio, buying and selling stocks, those tax bills can be passed on to their investors each year. And investors themselves buy and sell those mutual funds, generating capital gains for themselves. Jeffrey Talk from Morningstar recently crunched the numbers and showed that if you factor in taxes to mutual fund returns, about 96% of mutual funds underperform a passive strategy over time. Now, I'm not a passive zealot. I think a lot of active managers can do very well over time. Warren Buffett, of course, being one of them. It's just so easy to ignore the role of taxes over time. Most investors find outperforming the market hard enough. But outperforming the market when Uncle Sam takes his share every single year is so much harder. The evidence shows that virtually nobody can do it, since the excess returns necessary to beat a buy and hold strategy are so huge after taxes. But how often do you hear that? The majority of investing brain power in this industry is devoted to the pursuit of higher investment returns, period. Just how can I earn higher returns? That's where the money is. Taxes are so easily overlooked because they only come once a year, well after your gains have already been booked and mentally rewarded and maybe advertised to your clients. Now, we could add so much more to this topic. Different tax brackets depending on where you live and what your income is, different state tax, different estate planning rules, or the near certainty that tax rates and tax laws will change over the next 20 years. Few topics are as gray and complicated as taxes. But regardless, the goal of all investors should be to increase their after-inflation, after-tax wealth over time. That seems like such an obvious statement. But how did you answer the Genie question above? The power of delaying taxes is far more powerful than many investors think.